When you have unmanageable debt and begin researching professional debt relief options, you'll be presented with two common choices: credit counseling and consumer proposals. I'm Doug Hoyes, a licensed insolvency trustee and the co-founder of Hoyes Michaelis Associates right here in Ontario. Let's compare both options to help you make a confident, informed decision about the best path forward for your debt recovery. In Canada, credit counseling offers a consolidation program called a Debt Management Plan, or DMP. A DMP is generally best for individuals who carry smaller debts because, to qualify, you must agree to repay 100% of your unsecured debt over 3 to 5 years. Unsecured debts include credit cards, bank loans, and payday loans. They are not secured by anything. A secured loan would be a car loan secured by your car, or a mortgage secured by your house. DMPs deal with unsecured debt. In a typical DMP, all future interest is reduced or stopped entirely. You make one monthly payment to the credit counseling agency, which then distributes that money to your creditors. But here's the catch. Creditors' participation is voluntary. A DMP is not legally binding. The people you owe money to don't have to accept the plan, and even if they do, they can withdraw at any time. In a DMP, there is no legal protection against actions like wage garnishments. If you file a DMP, wage garnishments only stop if the creditors agree to stop them. What if you have 5 debts, maybe 3 credit cards of $5,000 each and 2 payday loans of $1,000 each? That's $17,000 in total. The 3 credit card lenders may agree to the DMP and agree to accept the proposed monthly payment. But if the 2 payday loan companies say, hey, forget it, we want all of our money, they can still each try to collect their $1,000 plus interest on your next payday, which means you won't have the cash flow to pay the DMP. You need a solution that deals with all of your debts. That's where a consumer proposal is a great option. A consumer proposal is created by federal law, the Bankruptcy and Insolvency Act. In a consumer proposal, each of your unsecured creditors gets 1 vote for every dollar you owe, and if more than half of the dollars agree, the proposal is legally binding and all creditors must accept the deal. So, in my previous example, where you have $15,000 of credit card debt and $2,000 of payday loans, if 2 out of the 3 credit cards vote yes, that's 10,000 votes. So even if the 3rd credit card and both payday loans vote no, your consumer proposal is still accepted because majority rules. Now, the amount you pay in a consumer proposal is based on your income and your assets. The more you earn, the more the creditors will want in your proposal. But in most cases, unlike in a DMP where you pay 100 cents on the dollar plus a fee to the credit counseling agency, in a consumer proposal, it is possible to pay much less than the full amount owing, perhaps only half or a third or even lower of your total debt. A consumer proposal sounds great, so why would anyone ever do a DMP? Well, a DMP is a good option if your debts are small enough that you could pay them off in a year or 2 or 3, but you need a break on the interest. If you owe $12,000 on your credit cards and you can afford to pay, let's say, $400 a month, you can have them paid off in less than 3 years with a DMP. But if your total debt is $50,000, a $400 a month DMP would take well over 10 years to complete, so it's not a realistic solution. In a consumer proposal, depending on your income, the creditors may be willing to accept only $300 per month over 5 years, which is a much more affordable plan. Again, a DMP is a good option if your debts are small enough that you could pay them off in 1 to 3 years, but you need a break on the interest. For higher debts, a consumer proposal is a more affordable option. Other than with large debts, when is a consumer proposal a better option than a DMP? Well, when you have a lot of debts, it's hard to get everyone to agree to a DMP, but it's much easier to get more than half of the dollar value to agree to a consumer proposal. And there's one other debt that we deal with all the time in a consumer proposal, but it's impossible to deal with in a DMP. Taxes. CRA will not make a deal for less than the full amount owing in a DMP. They want everything, including interest. But because a consumer proposal is governed by federal law and CRA is the federal government, They can and will accept a consumer proposal and be bound by it. Choosing between credit counseling and a consumer proposal depends on your specific situation. Credit counseling might work for you if you have smaller debts and can afford to repay them in full. If you're dealing with larger debts or require legal protection or need to include government debts, a consumer proposal is usually a better option. There's little difference in how these debt solutions affect your credit rating, as both are reported as an R7 rating on your credit report, indicating that you're in a debt repayment program. This rating stays on your report for a maximum of 6 years from the filing date or 3 years after completion, whichever comes first. Each person's situation is unique, and if you're watching this video, that's a great first step in solving your debt problem. The next step is to get personalized advice. At Hoyes Michaelis, we offer free, confidential consultations with licensed insolvency trustees to help you explore all of your options. So contact us. Or start by checking out our library of free Canadian resources to answer all of your questions at hoyes.com.